yourself first.
Hello, I am Nicholas.
Okay.
My name is Richard Shaw.
My name is Rafi speaking.
Okay, and we'll set the time.
Today we are here as consultants of the Federal Reserve to give you a presentation for the Boston Fed Challenge 2015. And we seek to understand the current state of the economy and how raising or lowering interest rates may have a positive impact on the economy.
We will provide our recommendation for what the Federal Reserve should do to improve the economy, as well as the benefits and downsides of our current monetary policy. We will also touch base on how to handle the Fed's current balance sheet.
We also talk about how oil has a direct effect on the economy, particularly inflation rate and the core PC inflation rate.
Our recommendation is Operation Liftoff, raise the Fed funds rate. Our plan is a conventional tool that has been used by the Fed, and we want to de-emphasize short-term data dependency as far as when to raise the Fed funds rate. Raising our Fed funds rate at a predictable time and consistent rate is key. 250 basis points or 2.5% by the end of March 2018 is our goal.
At that point, we will reevaluate and see what effects our policy has had on the economy and give ourselves time to establish what further actions need to be made, if any.
Now, when and how should liftoff take place? We really need to stress communicating our plan to the economy for their own benefit. Announce the decision after the December 16th FOMC meeting of the Fed and begin liftoff after that meeting as well with 25 basis points. And every 3 months after that, we will continue to raise it by 25 basis points and again stop on March 2018. To effectively carry out the Fed's dual mandate, we want to build long-term demand by using certainty. For maximum employment, as aggregate demand increases, supply will obviously increase as well. You will see businesses, to meet that demand, they will have to hire more employees to accommodate this. As far as price stability, consistency with our Fed funds rate will control the inflation, and the Fed's balance sheet will also serve as a safety net if inflation gets out of hand. We are targeting 2% in target inflation and GDP target growth of 2.5 to 3%. To understand where we are now, we have to look at current monetary policy, and right now we're going to talk about its benefits. Zero interest rate policy and large sum asset purchases have been in place since 2008 as a response to the financial crisis. It is an incentive to borrow to boost demand. It gives the economy an incentive to invest into the stock market, hopefully creating a wealth effect from an inflated stock market. Consumers will feel more wealthy and hopefully spend more.
Now, in order for the wealth effect to be effective, consumers and investors need to recognize that it is in fact permanent. However, what we have seen is that this is artificially inflated asset prices in the stock market. We do recognize the stabilizing effect of the first bout of quantitative easing. However, when we look at the second and third bouts of quantitative easing, we see little to no positive impact and possibly even a negative correlation in real GDP, industrial production, employment, as well as the personal consumption index.
We believe our current economy is based largely off of perception, and that if the Fed shows confidence, then the consumers as well as the economy will echo what the Fed is doing in regards to confidence and have a larger and more positive impact. Uncertainty within the economy currently causes velocity to slow down.
With consumer confidence high as it is now, we urge you to raise rates. The downside of the current monetary policy is low rates have become the norm. There's no incentive to spend now if rates are going to continue being at this low level. It encourages stock buybacks, for example, Walmart. It doesn't encourage them to invest and expand. It hurts savers by offering such low rates in their bank accounts and incentivizes chasing higher yielding investments, which is obviously posing a danger to the financial system, possibly creating another asset bubble.
When you couple the fact that consumer confidence has risen to levels that were equal or even better than pre-recession levels, with the fact that the jobs report that came out this morning, we were expecting 180,000 new jobs with a 5.1% unemployment, and we actually saw a 271,000 gain with 5% unemployment. So we believe that that will in turn return velocity of money due to consumer confidence up and the fact that we are gaining better numbers in employment. The marginal utility of quantitative easing. We must look at the trends and the correlations that we've seen in the past, and that it's drastically different now. Velocity of money stock is going in the complete opposite direction of the stock market, which is a complete perverse reaction. We look at the Fed's balance sheet and it's rising almost equally with the S&P 500, which just shows us that quantitative easing is artificially inflating the stock market. Now, the Fed's balance sheet, was this all really worth it? When we look at quantitative easing, the growth of the Fed's balance sheet, we see excess reserve, inflation of the excess reserves in banking systems. We see $2.6 trillion in excess reserves, which ultimately, due to the multiplier effect and the 10% reserve ratio, allows banks with the possibility of $26 trillion in loans.
The next question the Fed may ask is negative interest rate an option? And we do not believe it is. Negative interest rates should only be an option if we see a recession occurring if we were already at the zero lower bound. Going below the zero lower bound is too dangerous right now. With too much money in the economy, inflation could skyrocket if we see velocity increase.
Now, in regards to investors, currently they are chasing higher yield, which in May of 2014, Janet Yellen warned investors about chasing higher yield. Often this is the case because the yield itself, which is often higher than bonds and CDs and current safer investments, is perceived from a riskier manner, and defaulting these investments would crush an already slow economy. Raising the federal funds rate would create demand for treasury bonds.
As we've seen, U.S. Treasury bonds are relatively low, historically speaking. Our plan will increase the demand for new U.S. Treasury bonds, resulting in a much safer and stable market. With safe investments, of course, the economy is better off.
Now we begin to segue into inflation and how oil plays a part in that. We see that the core PCE is a 1.9% inflation rate, and we have a target of 2%. So we ask ourselves why we haven't done it, and we recognize that the volatility of oil is ultimately bringing down the inflation rate with extremely low prices. We've seen a consistent correlation between supply and demand of oil through the first quarter of 2015, but we began to see it go in opposite directions, we believe due to growth in fracking and low demand. Now, the core PCE versus non-core PCE, and we recognize that the Fed puts a particular focus on the core PCE for good reason, and we've seen a 1.9% annual rate of inflation currently. We also believe that the oil market is unprepared for a sudden increase in demand due to the fact that oil rigs in the United States are down 60% year over year, and couple that with the fact of geopolitical barriers in the Middle East and the fact that rising tensions in the Middle East could have a negative impact on the supply of oil. Data also suggests an impending increase in demand for oil, as we see in U.S. heavy truck sales have spiked drastically recently, and this correlates to stronger demand from low gas prices, which we believe will ultimately raise inflation.
The Fed's hawkish sentiment as a result of the October Fed FOMC meeting supports our strategy. The Fed is looking for current economic factors to possibly increase the Fed funds rate after the December meeting, which is exactly what our plan is. The Fed is looking for wage tightening, and as of Wednesday, Janet Yellen was quoted as saying the U.S. economy is performing well. And this also ties into our plan as far as adding encouragement and certainty to the economy is exactly what we want to increase spending.
We also recognize that in the past, the Fed has put particular emphasis on the Phillips curve, and there's a debate out there that the Phillips curves may not be relevant. But one thing we need to look at is that we may need to redefine what full employment is due to structural changes in the globalized economy. And due to the fact that also after a recession, we see a large jump in marginally attached workers. And we tend to put a specific focus on independent, like aggregate demand or aggregate supply. And we believe we need to put a particular focus on both aggregate demand and aggregate supply. And also recognize the fact that the Phillips curve itself may have shifted to the right. With civilian unemployment, we see secular stagnation since the recession, and that's why we believe the U6 unemployment rate is better reflective of the current economy due to the large spike in marginally attached workers, which the U6 does in fact take into account. When looking at the strength of the dollar in emerging markets, when we raise interest rates, we have a relatively tight policy in respect to the rest of the world. So when the dollar rises and it becomes more valuable, in particular emerging markets who denominate their debt in the dollar, it makes their default rates go up, which are already high. So it has a particularly short-term negative impact on emerging markets, but in the long term, the U.S. needs to be the leader of the world economy, which ultimately increasing production and consumption in the U.S. will boost the economies around the world.
Now, in regards to our plan in raising interest rates, safer investments currently are no longer a viable option to investors. Historically, safe investments such as bonds are negatively affected by low interest rates. Retirees, pension funds, and consumers looking for safer investments are often left either being pushed towards higher risk and higher yield investments such as the stock market, or being stuck with a near 0% rate on several of the safer investments. One of the safer terms where people often put their money is in a money market deposit account or an MMDA. Now, prior to the recession, they had offered rates near 4%. However, currently the rates are not attractive at all, near zero, which pushes buyers to riskier investments. Another safe investment that has seen historically low rates due to the fact that the interest rate is near zero are government-issued bonds as well as treasury bonds. The figure that you see right there is the 10-year government bond yield, and it's near zero. And we believe that with our plan, those rates will rise. So the stock market is where consumers as well as investors will put their money looking for a yield. And as Janet Yellen warned, higher yield investments are often riskier. The result of the Fed meeting caused an increased activity in the stock market, which we saw in October. The market knows when the funds rate is changing, and it may cause a similar reaction when it legitimately occurs. What I'm trying to say in short is that the Federal Reserve is held hostage by the markets. Data dependency is a large factor in regards to the changing of the interest rate. Our markets are altered based on perception.
We've seen a perverse correlation between quantity easing and the stock market growth. Stock markets should reflect the present value, the stream of future expected corporate earnings, but the problem is they are not. We're seeing this perverse reaction where bad news tends to correlate to a jump in stock market growth, and good news tends to correlate to a drop. This creates a false sense of security for consumers and investors.
Another question we must answer is why is data dependency important in removing it from the equation? Economic factors will never be perfect in the current economy. The Fed has had opportunities in the past to raise rates according to their statements. They wanted to raise rates when they saw 2% inflation, but they refused. This created more uncertainty in the economy and hurt us. The Fed should focus more on where are we going to go, not where we are now. And we believe with our plan, the economy will self-adjust to any small ripples that affect us negatively.
A particular obstacle we face with raising interest rates is the U.S. national debt, and that, in effect, when we raise interest, when the Fed funds rate goes up, also effectively does the interest on our debt, which makes it ultimately harder to pay. But couple the fact with velocity of money returning, demand for oil returning, we believe that will boost inflation, but also boost growth, which will ultimately allow us to cover that extra interest on the debt.
Now, what is our plan with the inflated Fed balance sheet? In an ideal synchronized economy, you'll see the money supply grow as the population grows and GDP grows. Currently, we're seeing a huge jump in the money supply. Population is obviously growing, and GDP is not growing at a rate that we would like it to be. With our plan, we intend to let maturing assets run off, and we will see about half of the Fed's assets run off in 2018. And we will proactively sell any more assets necessary to combat inflation if all that money in the balance sheet accelerates faster than expected, accelerates velocity. Again, our goal is 250 basis points or 2.5% by the end of March 2018.
Now, in regards to certainty and what we discussed earlier in this presentation, the stock market was negatively affected by the decision that was looming, will the interest raise or not. And with our plan laid out, investors will have the dates of when rates will raise, consumers will have it, everyone will know when rates are raising. Therefore, certainty will be created in our otherwise uncertain economy, and we will have the perception that, okay, rates are changing, let me capitalize now, rather than hold off and cause uncertainty.
And after two and a half years in March 2018, we would like to reevaluate our plan and look at the current state of the economic activity and determine whether inflation rates and target growth have been achieved. And if we truly have achieved that, we want to entertain the idea of a Fed's hands-off policy, where the Fed would not be involved extensively in times of crisis.
And just to elaborate, with a laid out plan, which the entire economy knows, we will see that businesses will plan for raising interest rates, and if they do not capitalize on these before we raise rates, they don't miss out completely if they wait for the next one.
Thank you.
And that's
Thank you. Okay, we're now going to enter into a discussion period, and it will last for 10 minutes. And let me start the timer, which I can set properly. Okay, judges?
Okay. We've asked this question of everyone. Why would the Fed be concerned about analyzing today's unemployment rate? would they be more concerned about the U3 or the U6, and why?
Well, we believe we actually may have answered that question for you in our presentation. We believe the U6 has more relevance than the U3 because after, like we said, after a recession, marginally, we see a large spike in marginally attached workers, which since the U6 takes that into account, it would better reflect that. And we also believe we should redefine what full employment is due to structural changes in the globalized economy. So we think that ultimately the current employment rate is realistically between the U3 and the U6.
If it was adjusted?
If it was adjusted.
Does this 271,000 increase in employment payrolls make you more confident or less confident with your
So,
policy?
this increase in payrolls sort of makes our plan even more confident, just because the data, again, backs up the fact that we should raise rates. We see all the evidence that the stock markets are performing better, employment is up, everything is performing better, and the fact that expected unemployment is even down to 5%, which was better than the 5.1% that was passed.
And so to elaborate on that, our whole plan is to instill confidence in the economy, and these rates, we were expecting, as reports, that we were seeing about 180,000, and for almost double, it's just creating more certainty for the economy.
So, in short, to answer your question, yes, this would.
What I was going to say though is you made an important point here about moving the Fed away from data dependency. And you've laid out this path of 0.25, come hell or high water, maybe. But now you're telling me that seeing this number today actually makes you more confident, which it may well. But my question is, if you give up data dependence and you wait till 2018, and so, suppose we have some crisis in China, and China really goes into the tank, and you have some global downshifting. Would you change your policy path, or what would make you change your policy?
So, in regards to our belief that data dependency has slowed down the growth of the economy, short-term data dependency is what we were referring to, and the Fed currently is still data dependent, and we are just pointing out that the data shows that the rates should increase in December.
And also, when we go back to the Phillips curve, traditionally, we look at short-term data to determine long-term trends with the Phillips curve, and I believe we need to put a larger focus on long-term data to determine longer-term trends, because things we're seeing in the economy right now may be a result of something that was going on maybe 6 years ago. So we have to recognize that.
Also, if we do see, like you said, an issue in China, our plan is not so rapid that it's going to be difficult to bring it back to, or if we have to increase it or lower it. We're not making drastic changes rapidly.
So you would be data dependent?
We would
More long-term than short-term.
long-term data dependent.
Well, and when we look at China, this goes back to the strength of the dollar, and when we raise interest rates, it won't make a large impact on China negatively, because what China is doing with their currency is they're trying to enter the International Monetary Fund's basket of currencies in order to hedge the value of their currency against things like the dollar, the euro, and the Japanese yen, which will ultimately improve their currency and their economy.
Now, Mr. Murphy, when we refer to data dependency, we are simply pointing out that regardless, come hell or high water, like you said, the rates would increase, just because we believe that things aren't always going to be perfect. So we would be somewhat data dependent in the sense that we would look at data, however, we would not base our decisions in regards to our 3-year plan on data until after 2018.
And again, throughout this plan, as rates increase, we're always going to be evaluating the status of the economy. So again, like if you said there was a large issue, we'll be ready to act if necessary.
When we talk about the policy of the Fed, it has been inflation targeting of that 2%. Do you think that has been effective? Has that retarded our growth? And I don't remember, what did you say you would do about the balance sheet of the Fed?
So we want the assets that are going to run off as far as in 2018, we're going to let those run off. And because we have such a huge amount of money in the stock market, and we want to increase demand. And if there's such a large amount of money in the economy, we could see velocity and inflation just skyrocket. And if we do see that, we have the other assets we can sell off to control the money that is in the Fed balance sheet and also control the inflation.
And with the Phillips curve, if we were to redefine what full employment truly is, because right now we define it as around 5%, which when you look at the Phillips curve ties into a equilibrium 2% inflation target. So when you redefine full employment, you would possibly be redefining what your target inflation is.
You mentioned, being concerned about longer-term issues and taking the long view. And you also mentioned that in your policy path, you're building in some kind of long-run target for GDP, real GDP growth. I wonder if you could speak to what you think long-run potential GDP growth is currently. There's been a lot of discussion that maybe it's slowed in recent years. And secondly, if you could justify why potential GDP growth may have downshifted.
I would just like to say that with the 2.5 to 3% target, that may be actually a large S target, due to the fact that, like the structural changes in the globalized economy, we're redefining what work is almost, particularly in America, because we're moving away from jobs like unskilled labor jobs, and we're moving to even more so growth in the technological field of America is growing more than the unskilled labor. So it's going to become harder for people who do not have skills to work. So we may be working towards possibly a lower average GDP.
But if I asked you, why 2.5%, what would you tell me in terms of the pieces that go into that 2.5%?
As far as historically speaking, we believe that 2.5 to 3% has been a healthy rate, and as of now, we feel that should continue.
Then when you think about what the Fed is doing and what would you describe their forward guidance right now as?
So,
And do you think it's being communicated effectively?
I would say the forward guidance isn't being communicated effectively, and that's basically what our whole plan is to communicate the plan, because we realize we live in a perception-driven economy, and that if the Fed exhibits confidence, we believe the consumers and investors will react positively to that. So forward guidance needs to be consistent, and they need to really let the people know what's going on.
providing a plan as well as like a guideline for consumers, investors, everyone would basically know what's going on when, the uncertainty would be removed from the equation, which would possibly have a positive impact on many different things, including markets, GDP, several other factors that currently, as you see from the stock chart that I showed you earlier, have been impacted by uncertainty from the Fed decisions.
You mentioned, of course, starting this path upward with rates, Fed funds rate, and doing this through 2018 and then reevaluating. In the current environment, again, you're going to let the balance sheet start to run off a bit, I know that. But we're still going to have a pretty huge balance sheet for the next several years. How do you get the Fed funds rate to move up if you've got so many excess reserves out there?
So the way that we get our Fed funds rate to move up is slowly, and this is why our observation period comes in handy as well in 2018.
How do you do it sort of technically?
Well, tying in with excess reserves, we believe we do two things when we raise interest rates in a consistent manner. We do increase confidence in the economy, but at the same time, we believe there's going to be a dramatic spike in things such as oil, which will increase the inflation rate. So by raising the interest rates, we'll be able to keep a little bit of control on the inflation.
But how do you actually?
So how do we actually?
How does the Fed
correct?
raise?
So
the
in
Fed
terms
funds
of how do we actually raise the rates, the FOMC meets 8 times
Yeah.
a year. During those meetings, it will be a guaranteed increase, and
How do they actually make
They use conventional and unconventional methods, and prior to 2008, we generally used conventional methods with short-term securities, and in 2008, we used large-scale asset purchasing programs to change the composition of the balance sheet, which largely went towards long-term securities like mortgage-backed securities.
That was time over there.
27 seconds.
27 seconds.
Okay, just to pursue that one step further. So you're arguing that we would carry out open market operations to raise the Fed funds rate? But we've got so many excess reserves, you're going to have to probably take 30% of those excess reserves out of the system to move the Fed funds rate.
Can I-
Speak to that.
All right. if we can, because we would proactively sell bonds
Okay,
in order to,
okay,
in order to take money out of the
yeah,
market.
sure, okay, that's fine. Good, well, thank you, this was informative.
Thank you, A3, nice job.
Thank you, guys.
So now you can relax.